What is going on, investors? Hopefully you guys are having a great day out there. Time to kick off earnings season again here on the Investor Channel by taking a look at JPMorgan and Chase Bank, ticker symbol JPM. They just reported their Q2 earnings today before the bell, and so we'll take a look at them. We'll dive into the numbers. We'll also take a look at some macro stuff that could help drive higher revenues here in the future for JPM. We'll take a look at some traditional valuation metrics as well when we're talking about JPM, compare them to some of the other banks, and then we'll obviously get into the report when it comes to JPM. One of the reasons why I love going over these reports when it comes to large consumer and commercial banks like JPM, which is one of the largest, it gives you a window not just into JPM's business, it gives you a window into the entire economy. And so we get to see, are consumers taking more loans? Are they depositing more money? What's the feeling out there in the economy? If you understand what's going on with the banks, you can make better judgments with all your investments, not just JPM. We'll take a look at their revenue, obviously, through all their business divisions, and then we'll jump over to the stock chart as well. This one's been on a nice run, sideways consolidating. We'll see if we can kind of predict or at least give you some insight on which way this stock is going to go here in the near future. Now, over the last year, this thing is up 64%, which is a monster move for a mega cap bank. We got a $471 billion market cap on this one. You do still get a 2% yield on this one. That's actually not bad compared to almost all stocks out there. And that's good for $3.60 per share on the dividend. We've got a forward PE of 12 on this one. We'll take a look at valuation metrics here in a second. Now, their Q2 earnings came in, and I think some of the headlines are going to be weaker fixed income results, and they trimmed their NII, which is net interest income, essentially profit, and they trim that guidance just a little bit. We'll take a look at that here in a second. But what came in this morning too, also right as JPM was reporting their earnings, was core inflation rose to a 30-year high. Like back in 1991, I was in grade school. Back in 1991, this thing grew to a high of 4.5%, obviously exceeding a little bit. I think, the Federal Reserve will tell you their target is like 2%. They said they'll let it run a little hot. I think this is getting into the hot range. Okay, whether or not this continues, okay, now we've got to see if this follows through. Next quarter, next month, even next year, you get core inflation readings like this. Guess what the Fed's going to have to do? They're going to have to raise interest rates. And guess what's going to happen to JPMorgan and all the banks' net interest income? Well, if you raise interest rates, it's going to go up. So if you're bullish on banks, you're probably bullish on inflation and bullish on the Fed actually having to do something about it. It's a lot of things that are going to have to happen, but it appears the chips are starting to line up in that favor. Now, from a traditional valuation metric, I don't necessarily think these are all that useful, especially when we're talking about other stocks and especially when we're comparing stocks to one another. But I think you can do it with banks because you got this price to tangible book. You basically liquidate all the bank's assets and you're left with a pile of cash, hopefully. And here's what you're paying on a premium to that. Now, JP Morgan's always traded a premium, at least over the last 3 years, according to this chart. They're here in orange, and I'm comparing them to Bank of America in blue, Wells Fargo in purple, and Citigroup in green. And JPM's just basically always traded at a premium. We're seeing the group approach levels where we were kind of pre-virus, where they kind of fell off the map. So either we're back to this level and we're going to kind of hover here. Now, in order to expand this price to tangible book, what do I think needs to expand? I think consumers and businesses are going to need to take out more loans. And I think the Fed's going to have to raise rates. At least the market's going to have to believe they're going to do that. That could give you some multiple expansion in the banks. It could that we already seen people anticipate this because these multiples have been expanding, especially with JP Morgan, again, being to 3-year highs. Essentially all these stocks, not quite Citigroup, but most of them are close or at 3-year highs, at least on a price to tangible book basis. Now, let's jump into the numbers. Jamie Dimon came out and said our earnings, not including the reserve release, which we'll talk about here in a second. If you're not sure what that is, I'll talk about it here more in a second. But their net earnings was $9.6 billion. It was actually more than that if you include the money that they released from their reserves, which are held aside for credit losses, like you default on your credit card, your car payment, your home loan, whatever it might be, your business loan. Well, they were able to release some of that back into the company. We'll talk more about that here in a second. Now, what I want to do is just look at a high level. So they got these firm-wide metrics, but here's consumer and commercial banking right here. Average deposits up 25%. So it's showing a very healthy, or at least a relatively healthy consumer that is depositing more money. Okay. Now, average loans were down 3%. So it is still showing somewhat of a risk-off momentum, or at least at the current time, people are not borrowing more money. So we're not while we're seeing core inflation, like the reading come through, I think if we want to see follow through with consumers borrowing more money, because if you believed that prices were going to be much higher a year from now, 2 years from now, what would you go do? You'd go borrow money, because you borrow money today and it inflates. Well, it makes more sense to borrow that money today. Whether or not consumers and businesses are really thinking along that lines, I don't know. All I know is average loans are still down 3%. Now, we're seeing other evidence of that as well in the investment banking world. We're seeing average loans down 12%. Some of that makes a little sense, because what happened is right when the virus hit this time last year, a bunch of companies just drew on their credit lines. Okay, they weren't sure what was going to happen, like almost everybody. Okay, right? And so what they did was they drew down on their credit lines, and they just they borrowed tons of money. You can go look at, balance sheets and videos that we did last year. Companies were just pouring money onto their balance sheet because they weren't sure what was going to happen. So we're seeing average loans in the commercial banking, and corporate banking world come down, and we're seeing deposits come up as they, maybe deposit a little bit of the profits that they've made, and maybe deposit some of this money that they borrowed over the last year. Now, JPMorgan Chase, this is firm-wide results here. So we've got our net revenue here. We're seeing here, this is quarter over quarter. Middle column was last quarter. The left-hand column is the most recent quarter. The right-hand column here is a year ago. We're seeing this is down across the board, right? So our net revenue down year over year and quarter over quarter. Here's our non-interest expense up a little bit. Jamie Dimon talked about this. They're doing more investing in the business. They're trying to spend a little bit more money, reinvest in JP Morgan. I got no problem with that when you take a look at the provision for credit losses. So what we talked about last year, this time, nobody knew what was going on. Everybody was working from home. Things were shut down in a major way. So what was JP Morgan and all the banks doing? They were setting aside money because they didn't know if people were going to default on their credit cards, their home loans, all this stuff. Well, what they didn't know was the United States government, and really government across the world, just injected a ton amount of money into people's bank accounts, PPP loans, stimulus checks, rent forgiveness, all this type of stuff happened after Q2. And so what happens is JP Morgan and a lot of banks set aside, in JP Morgan's case, $10 billion in one quarter. They were set aside that, and it really hurt profitability. You see net income came all the way down to $4.7 billion in the quarter. Well, they started releasing it here in Q1, $4 billion, another $2 billion. This is money. This was basically money that JP Morgan was putting in a quote unquote bank. Okay. They put $10 billion in the bank. They said, well, if people default on their loans, we want to have some money set aside. Then they started realizing, well, people aren't defaulting. In fact, they're depositing more money into the bank. So they get to release that money back into their bank account, essentially into JP Morgan's bank account. So they released $4.1 billion and they released $2.2 billion. And you see what it's doing to net income. Okay, we went from $4 to $14 billion, and we're here at about $12 billion. That's why Jamie Dimon talked about minus this 2.2 billion, you were at about $9 billion in terms of earnings on JP Morgan. Now, what I want to do is take a look at one of their largest business units is quote unquote CCB, which is consumer and community banking. We've got net revenue here relatively flat. Okay. Again, we've got year over year up just slightly, quarter over quarter up just marginally as well. So even though we're seeing some drying up in loan demand, we are seeing they are squeezing some money out of that net revenue. So we've got consumer and business banking, again, up just slightly. Home lending, we are seeing taper off a little bit. So that might give us a window into maybe consumers are just not demanding home prices. Obviously, nobody needs to tell anybody where home prices have gone over the last year. They are astronomical. And so it's possible we're seeing a little bit here that the consumers are starting to reject those prices, or at least not willing to pay those prices. So, and I think we're seeing data when you're talking about home lending and you're talking about home prices that they're still going up. Don't get me wrong, but they're starting to slow a little bit, and we're seeing evidence here because if consumers were willing to pay those high prices, well, you'd see lending continue to go up. You've got card and auto. We're seeing this basically flat from a rounding perspective, essentially flat as well. You've got your non-interest expense basically flat, although up year over year because, again, JP Morgan is doing a lot of reinvesting in their business. Now, finally, we've got their provision for credit losses. This is a provision of the $10 billion that we saw up there. So we've got 5.8 billion that they added on the consumer side last year. They released last quarter 3.6 billion. They released another 1.8 of it. So we've almost released all of it. Okay. And that gives us a nice net income of $5.6 billion in that business unit. Now we've got our corporate and investment banking. We see our net revenues here actually declined quite a bit. Okay. So we had Q2 was super high on the revenue side. And again, we talked about this a couple minutes ago. Last year at this time, what were corporates doing? They were drawing on their revolving credit lines. They were borrowing. They basically were taking as much money as they possibly could out of their JP Morgan accounts. They were leveraging up their business as much as they could because they didn't know what was going on. And we've slowly seen a tapering of that off. Okay, balance sheets at the corporate side are super healthy because the consumers are relatively healthy and a lot of businesses didn't fall off as much as many people thought. Okay, and so most companies survived the virus very, very well. And so we're seeing a decline in that corporate investment bank activity. Everything else looking relatively flat. This markets and security services fell off quite a bit, and non-interest expense again down a little bit, probably likely to do to how the business income slid on this as well. We've got net income coming in at about $5 billion. That's off a little bit over what we've normally done here. You'd like to see this tick up. What could make this tick up is probably a little bit of driving up interest rates and those types of things. Have interest rates drive up, that'll probably spook the markets a little bit, and that might require corporates to draw down more money, do a little bit more investment banking activity. Now, finally, we've got commercial banking as well. We've got the net revenues, again, looking really flat, okay? And we're just seeing just relatively flat. Now, they're not quite doing the provisions for credit losses here, okay? On the commercial banking side, okay? We added this 2.4 billion and we took away 118, took away 377. So they haven't been, and I'm talking about JP Morgan here, as aggressive as pulling back those provisions for credit losses on the commercial banking side. And that makes a little sense, right? Restaurants, mom and pop stores out there, probably not quite as healthy as the corporate side is in terms of public companies that got to draw down huge revolvers and just access to all this capital and all this leeway with shareholders. The mom and pop business, the mom and pop restaurant is probably still struggling. And so they still have some of these provisions for credit losses still sitting on the books, still massively profit. In fact, our net income of 1.4 billion in this unit is higher than anything that we've seen quarter over quarter and year over year. Now, finally, getting into JPM stock chart, we see this thing made a low back here and it has been on a monster run. You've seen interest rates kind of tick up and as interest rates have ticked up over the last, really the last 6 months or so, 7 months, 8 months, this thing has been on a rise. Now we've seen interest rates kind of stall. Okay, it's almost like they were taking off in an airplane and now they've kind of reached cruising altitude. Okay, over the last few months, interest rates have kind of started cruising along. So what's happened to JPM stock? Well, it's kind of I want to say it's bottomed out here, but it's starting to flatten out here. Okay, now we're still in a range down here. There's a really tight range between 150 and we'll call it 155. This has been an area of accumulation with the stock. You see here, look at this little red candle. Look at this big, gigantic volume. So buyers have stepped in. When this stock pulls back to 150, even this big red candle of volume, not quite on the 150, but we see heavy demand for JPM stock anytime it's pulling back into this 150 to 155 range, okay? In that price range, you're getting over 2% yield on this one, and you're also getting a little bit of protection and a little bit of upside if you have this inflation. Inflation will hurt the regular stock market. Maybe not in the short term, but if you do have this kind of epic inflation that some people are predicting, that will bring down the stock market to a certain degree, or at least put a lid on it to a certain degree. But you get a little bit of protection because banks will just love that, okay? Banks will love higher interest. And when you have high inflation, what will people want to do? They'll want to spend money and borrow money as fast as you can, okay? Because we've seen it with home prices, right? People saw home prices go up and up and up. What have we seen? Record amount of people trying to go out and buy homes, okay? Because the price just continues to go up and up. And what also have we seen in the housing market? Less people want to sell. If you look at inventory of houses for sale, less people want to sell. How come? Why are there less people wanting to sell their house? Well, because the price keeps going up and up. Why would I want to sell an asset that just keeps going up and up in price? And so we see some positive momentum here with JPM. I don't mind accumulating this stock anywhere where it's at right now, between 150 and 155. I don't mind buying that stock, especially if you buy into the fact that this core inflation might continue to rise and it will force the hand of the Federal Reserve to actually have to start tapering and raising rates at the same time. That will be very, very bullish for stocks. How much of that is priced into JPM already? I'm not exactly sure, but I think if you start seeing the Fed having to move a little sooner than expected, all these bank stocks probably have more to rise here in the coming years ahead. So hopefully you guys enjoyed this video. We'll be back again with lots more videos over the coming weeks covering all the earnings reports that we possibly can here on the channel. Thanks for tuning in today. Good luck with your investments.